Starting trading can be pretty overwhelming, so today I'm going to run through a thread that I did a few months ago about starting trading and how to get to profitability in 15 steps. So this thread is something I posted on Twitter a couple of months ago, and basically I wanted to write a step-by-step on how someone could start trading from nothing and get to profitability in 15 steps. Now this is a thread. You can find the original thread if you search @shifting_shares on Twitter. But step one, we want to find the exact types of stocks that you want to trade. And what I mean by that is specific sector, specific platform, specific market cap. So you might want to focus just on energy stocks. And with regards to platform, we've got the SETS platform, London's flagship electronic order book. We've also got the SETSQX platform, which is predominantly market makers. So these are two completely different platforms to trade. And if you want to trade SETSQX only, that's fine. If you want to do both, that's fine as well. But for me, I think it makes sense when you're just starting out to focus on one and become an expert on one, then move on to the other. Specific market cap, so I'm not looking to trade stocks more than $1 billion unless it's an intraday trade because they're just too big. They don't really move as much. Small caps, they do have wider spreads, so that can be an issue, but they do move generally quicker. So I'd identify a segment of the market to trade and focus on, and I then learn about these stocks, what drives the stock prices, the mechanics of the market. And I realised that is a bit vague. Twitter, you do only have 280 characters. So learn about these stocks. You want to learn about what they do, how they move, what drives the prices. Is it RNSs that are coming out that are driving the earnings? What is actually moving the price? Is it macroeconomic factors? Is it industry tailwinds? Once you know what levers are driving the price, that can give you a good idea of what's going to happen when various things happen. Alternatively, you can just open up a chart, look at when the stock has made a big move, then find out what actually drove that move. What type of news was it? Look back historically and find out what was driving the price. The mechanics of the market, so again, this comes into the platform. So SETSQX, you will be dealing with market makers. There is a SETSQX auction, but it's pretty illiquid and thin. So you will be dealing with market makers. What's the best process to do that? For example, exchange market size. This is something the suit's brought in to help private investors and people in the market dealing from RSPs, retail service providers. Now, what that means is if you're within the exchange market size, you won't be able to deal if the price is outside of that price. And I realise that probably sounds quite difficult to imagine. Let's say we've got a stock at 70 pence and the bid is 70 pence, the exchange market size is 50 pence. The exchange market size is 5,000 shares. Now let's say a profit warning comes out, we've got 4,000 shares, we try and hit the bid and sell on the RSP, but the RSP is only offering us 69 pence. Because of this best execution rule, which is supposed to help execution, what that means is your trade will not be able to execute because it's not best execution, even though that is the best price that the market makers are offering. Now, if you are outside of the exchange market size, so let's say you have 5,001 shares, the price is 70 pence, you're getting offered 69 pence, you will be able to hit sell and the trade will be executed. So that's just something to be aware of. It's just one example of the mechanics of the market. You do really need to learn and understand these, or at least have a basic understanding of how it all works. So we'll move on to number 2. You want to find the exact patterns you want to see in those stocks. And again, I would look at historical data and pattern match. So you want to look for commonalities among trades. identify the time frame required for the trade, and come up with a formula that can be repeatedly used. So it's pretty common knowledge. I like breakouts. I like breakouts that have traded sideways for an extended period of time and really shaken out a lot of weak hands. And then I like there to be a catalyst that'll drive the stock higher. Basically, I'm rinse and repeating this formula a lot, and that is my breakout formula. Thirdly, you need to work out how you can find these patterns repeatedly. You then want to know if you can find this formula for future trades. So this might require swapping ideas with people, software, or custom filtering. I use SharePad, and you can get a free month in the link below. All of my filters are on the SharePad filter library, so if you search Michael, they will all come up, all the filters that I use. Pick new information sources. Are you getting news the weekend FT? Where are you in chat rooms on Twitter? You're following journalists. You want to broaden that information source so you can distill it down and hopefully find something that you can use. I'll give you an example. 5 years ago now, was it? In 2017, there was a Twitter account that whenever it posted, it moved prices. So I just had it in its own column on TweetDeck, followed him. As soon as he posted about that stock, I would just buy it, and he'd ramp it up to his followers, and I'd sell out. And that, honestly, that paid for a holiday in Italy. It's a very crude strategy, but you want to find something that works and then exploit it. That is pretty much the goal of trading. And once you know how to find patterns, you need to know the amount of time required per day, week to find these trades. You want consistent idea generation, because if you don't have any ideas, you don't have any trades. So for me, that comes with filters. Again, I mentioned SharePad. It does need to be built into your existing routine to make it sustainable. There's no point having a 5-hour nightly routine if you don't have 5 hours to trade, to spare to find trades. Mine typically takes me 1 hour because I've got my filters set up and I run them and I go through the previous day's trades and everything. So, if you work full time, the amount that you can actually spend at the screens is going to be limited. So you do want to do things that are going to make it sustainable. Do the work required to find these opportunities. Again, you want to keep it on top of your trade inputs, news, software, filtering, idea swapping. You build that pipeline of potential trades. So if I log on to SharePad now, I've probably got about 50 to 100 alerts all set up that I've just accumulated over time. Some of them might have been set 2 years ago and they've just never hit. But if it does ever hit that price that I'd be interested in, I will get an alert and then I can quickly review the chart. And this business really is all about reps, and it's a cliche, but you do get out what you put in. Lazy traders lose money. That is the unfortunate reality. At least it's an unfortunate reality if you are a lazy trader. Build a morning routine to place these trades and monitor your business. Lots of traders like to wait to see if they're right before placing a trade. However, you are paid to execute when the risk to reward is in your favour. Once that trade starts moving the way that you expect it to go and then you get in, that risk to reward is coming down as the trade moves in your favour. You want to be executing at the right point rather than waiting for some sort of confirmation. Take the trade as your plan dictates. And with the morning routine, if you are a full-time employee, you can give a broker orders, or you can set stop limit orders. So for example, or you can even set limit orders. So with sets, the electronic order book, you can place orders directly onto the book using direct market access, DMA, which is explained on my website. If you search shifting shares level 2 DMA into Google, it will show up. But let's say you want to, the price is 80, you want to buy at 60, you can put a limit order to buy at 60 pence if the price goes there. If it does and you filled, then you were filled. If it doesn't, then it'll expire at the end of the day. Make sure that you are not using good till cancelled orders, because you will forget about them and eventually you'll end up being filled on a stock that you'd completely forgotten about. Stop limit. You can, let's say you want to buy a breakout at 80 pence, but the price is 70 pence. You can create a stop that triggers at 80 pence. Then you can place a limit order on top of that, which is stop limit, to buy up to 81 pence. Because what you don't want to do is have a stop market order, which is a market order is basically a blank check to get filled at any price, which you never really want to do because that is pretty dangerous. But we'll move on to 7. You start collecting initial data from your trades into a journal. I'd then create a simple Excel document with several columns, including entry, exit, position sizing, commissions, P&L, and emotional feelings. You don't actually need to do this because I've got one you can download on my site, a simple Google Sheets tracker that will work for you. And collecting data is essential because without it, you can't actually improve if you don't know where you're going wrong. And yeah, most traders don't actually track their trades, and most traders also lose money. There is obviously a correlation there. I'm pretty sure it's a causative one, and it's why people don't make money. Once we've done that, we want to open our journal to look at winning trades to find consistencies. And the reality is, in this business, a small amount of trades will generate most of your P&L. And if you can find the conditions for success, you can then replicate them. So look at the entries, what type of patterns are you using, the fundamentals, are there similarities in the business cycle, market conditions, you making most of your money in a bull market, probably going to be the case. What you do need to do is check what happens after you close a trade to see if you're leaving money on the table. Now, for example, let's say you close a trade at 100 and it then rallies pretty much to 150 without you in it. And let's say every time you close a trade, it keeps rallying without you in it. That's a sign that you're not driving your winners hard enough. So is there anything you can do about that? Can you take half off and run the rest? If you can tighten up your stop, you can actually take on more risk. But you can't do it without this data. And trading really is about losing less from your losers, making more from your winners, winning more from your winners, and increasing your potential trade ideas. And as I've just said, if you're closing too early, what are you going to do about it? Because this is a business on performance and you get paid for how you perform. Coming on to number 10, we want to work out how you can lose less from your losing trades. Traders are money managers. You do need to protect your capital at all costs to stay in business. Now, are you missing alerts to sell? Are you not honouring your stops? Are you getting slipped by your broker? Fix these for immediate results. Moving on to number 11, identify your most profitable patterns from your playbook so you can now trade these in larger size. And what I mean by that is you will scale vertically by adding lots of different trades to your playbook. Once you've traded these a lot, you then want to scale vertically the trades that are making you the most money. Most traders make the mistake of sizing up too quickly, and that can be very damaging for account. Try 20% increments on risk, not position size, because you should be adjusting your position size for risk on every trade. Only amateurs are using consistent position sizes. That's not something that we want to do. However, just be aware that your total risk on the trade is not the risk per trade, but the total exposure. So if you're placing 25% of your account into a stock, but even if you're only risking 1% a trade, yes, the risk per trade may be 1%, but the total risk is 25%. Now, stocks can go to zero. That is just the reality of this business. It's a hazard. It's going to happen at some point. You don't really want to be in a stock that then goes to zero. And remember, R is calculated by taking risk per share divided by position size. There is a position size calculator on my website, and that is free, so use that to then work back and check yourself. So as I've said, we want to trade our best positions in larger size and continually monitor your P&L to improve. This is just repeating what you're already doing with your journal now. So it's idea generation. We want to get plenty of ideas. We want to backtest that idea. Does this logically make sense? Should we even be testing this out? Execution. We move on to live testing with the trade idea, and then we refine it. So this is now just a journey, and we look for more patterns to scale up horizontally as well as vertically. Markets change and strategies can become obsolete any day. Breakouts could just stop working tomorrow, and then I'd have to rely on other patterns. Once you have a few profitable patterns, the focus should then be on finding new profitable patterns, and you want to build a playbook of trades. And you do need to continue learning because, as I've just said, the market changes, doesn't always stay the same. And those who adapt survive and prosper, and those who don't enter the annals of history. Remember, nobody remembers the former pit traders who didn't adapt to electronic trading. They got weeded out, they couldn't adapt, and so their trading days were over. Finally, we want to show up daily because profitability is a result of small actions compounded. It is about playing the long game. You never know which trades will be your big multi-hour winners on your bell curve, hence the need to stay consistent. So hopefully this explains that tweet thread in a bit more clarity. And as always, if you do have any questions, please let me know in the comments and I will do my best to answer them all and get back to you so to clear up any confusion. Thanks a lot for watching. Please don't forget to subscribe and I will see you in the next one. Thank you.